this is another important slide, tax payable and tax expense. So income tax payable refers to the tax liability recorded on the balance sheet as a result of taxable income. So income tax payable, so this is a tax term. Income tax payable is how much your taxable income is as calculated on your tax returns multiplied by the tax rate, and income tax paid is the actual amount paid for income taxes. This typically will be the same as tax payable. Now, why do we have this distinction? And the answer is pretty straightforward. Let's say that your fiscal year 2010 goes from Jan to December. On 1st Jan 2011, you can calculate your income tax payable, and let's say that you calculate this to be 5 million. This then is your income tax payable based on your tax rules. Then let's say that your taxes are due on 15th April. So it would be silly to pay this 5 million before the due date. So up till 15th April you show the 5 million as income tax payable, and then on the due date you actually make the payment of 5 million. So the payment that you actually make is the income tax paid. Occasionally the income tax paid might be a little different from income tax payable if there are cash flow issues or if you negotiate with the tax authority, but in our simplistic world, let's say that by and large the income tax paid will typically be the same as income tax payable. Now, an important relationship is shown right here. Income tax expense for a given year is equal to income tax payable for that year plus the change in deferred tax liability minus the change in deferred tax assets. And you must learn this formula. As we have said before many times, whenever you see this change in something, it is the end value minus the beginning value. So memorize this formula, that the income tax expense for a year is equal to the income tax payable plus the deferred tax, change in deferred tax liability, which is ending value of deferred tax liability for the year minus beginning value of deferred tax liability of the year minus the change in deferred tax asset, which again would be the end value of DTA minus the beginning value of DTA. An important point here is, and this will come up in the questions at the end of the curriculum, provision for income taxes. What we are calling income tax expense is sometimes referred to as the provision for income taxes. This is because the income tax expense is not the amount that you are actually paying. What you see in the income statement is the provision, or that's your estimate or your financial rule, financial accounting based number for what the income tax expense should be, and hence it's called a provision. So whenever you see provision for income taxes, think of it as synonymous with the income tax expense that you see on the income statement. Now, just to highlight that equation that you just learned and relating that to an example that we saw earlier with our deferred tax liability example. So if you recall, we said that on our financial reporting we had a tax expense of 320, 320, 320. This was the example where we had the 600 asset that was straight line depreciation on financial reporting and accelerated depreciation on our tax reporting. So let's take our equation and then see how it works. I will rewrite the equation over here. So we said that our income tax expense for a year is equal to income tax payable plus change in deferred tax liability. For now, let's assume that there is no deferred tax asset. So in year one, so let's take year one. In year one, our income tax expense 320 is equal to income tax payable, which is 280, plus the change in deferred tax liability. in year 1, our deferred tax liability at the beginning of the year was 0. At the end of the year, our deferred tax liability was 40. So the change in deferred tax liability is 40 minus 0, which is, so the change in the delta DTL is 40. 280 plus 40, and you notice that this equation holds. 320 is equal to 280 plus 40. And then what happens in year 2? In year 2, note, if you recall, the income tax expense and the tax payable was the same. So we did not create or reduce the deferred tax liability. So DTL remained 40. The change in DTL then was 0. So in year 2, the income tax expense 320 was equal to the income tax payable 320 plus DTL was 0. And then in year 3, notice that here DTL goes down to 0 at the end of the year. So the change in DTL is 0 minus 40, which is minus 40. And if we look at the equation, in year 3, our income tax expense was 320. So 320 plus income tax payable is, so 320 income tax expense is equal to tax payable, which is 360, plus the change in deferred tax liability, which is minus 40. And here again the equation balances. So you need to understand this well. And the quick way to deal with the deferred tax asset is, if you have a deferred tax asset, you simply do minus change in DTL. So what you do with, minus the change in DTA. So what you do with the DTA is just the opposite of what you do with the deferred tax liability. Changes in income tax rates. Deferred tax assets and liabilities must be adjusted for changes in tax laws and tax rates. If income tax rate increases, the deferred taxes will also increase. So whenever the tax rate goes up, whether you have a DTA or a DTL, they will both go up. And if income tax rates go down, then the deferred tax liabilities will go down, the deferred tax assets will go down. And the way you can think of it is, deferred tax asset, actually I've explained it over here. So what does a decrease in deferred tax liability mean? So it means that you had a certain liability in the future, which meant that you expect to pay a certain tax in the future. When the tax rate goes down, that liability becomes less. So that's a good thing. So this means a reduction of future tax payments to the tax authority. So when you have a deferred tax liability and the tax rate goes down, that's good news. Decrease in deferred tax asset means a reduction of the value towards the offset of future tax payments to the tax authority. So this is not so good news. The way you can think of it is, let's say that in the future, let's say you are still in 2010, and let's say that towards the end of 2010 you have a deferred tax asset of 2 million, and let's say that before any changes in tax rules in 2011 you are expecting a tax payable of 10 million, and this tax payable currently has nothing to do with the deferred tax asset. Now the tax rate goes down. When the tax rate goes, so actually before I talk about the tax rate going down, with this deferred tax asset of 2 and a tax payable of 10, what you were expecting to pay was 10 minus 2, which is 8. When the tax rate goes down, then the deferred tax asset will also go down. So let's say that will go down from 2 to 1. So if the deferred tax asset goes down, then your tax bill will be 10 minus 1, which is 9. So if the deferred tax asset goes down, your tax bill in the future will actually go up. So essentially that means that the tax rate going down is not very good news if you are sitting on a net deferred tax asset. So let's look at this through an example. Let's say firm A has a deferred tax liability and firm B has a deferred tax asset. The government announces a decrease in the tax rate. What is the impact on taxes payable for each firm? So let's take firm A first, which has a deferred tax liability. So let's say that this deferred tax liability is 5 million. This means that let's say next year the normal tax payable expected is so this is, let's say, tax payable expected is 10 million. To this we would normally add the 5 million, which is our deferred liability. So the total that we would expect to pay is 15. But if the tax rate goes down, then the deferred tax liability, let's say, goes down to 4 million. And now the tax payable will be 10 plus 4, which is 14 million. And this is good news. So for firm A, a reduction in the tax rate means that the overall tax payable actually goes down. What about firm B? With firm B, let's say that this firm B has a deferred tax asset equal to 2 million, and with firm B, again, let's say tax payable next year was expected without this 2 million impact to be 10, and with that deferred tax asset we were expecting a savings of 2 and hence an overall tax payable of 8. But when the tax rate goes down, let's say the deferred tax asset becomes 1 million, now the tax payable actually goes up, because from 10 we are only subtracting 1 and the tax payable becomes 9. So not very good news for firm B, which has a deferred tax asset. Permanent differences, what we have talked about so far, is generally referred to as temporary differences because they reverse. However, if differences between tax and financial reporting of revenue will not reverse at some point in the future, then we say we have permanent differences. These permanent differences do not give rise to any sort of a deferred tax, and we should treat them as equity for analytical purposes. Permanent differences can be caused by 1. Income or expense items not allowed by tax legislation, and 2. Tax credits that directly reduce taxes. There is a lot more to this, but from an exam perspective, as long as you simply learn what's on this slide, you should be in good shape. Effective tax rate. All permanent differences cause the company's effective tax rate to differ from the statutory tax rate. The statutory tax rate is the rate of the jurisdiction where the company operates. So basically this is the legal tax rate. So if you are in a given country where the corporate tax rate is 35%, then that's the statutory tax rate. The effective tax rate is derived from the income statement. So notice that this is coming from your financial reporting document, which is the income statement. So your effective tax rate is the income tax expense, which is again your income tax expense from the income statement, divided by the pre-tax income, which is your accounting profit. Key point is effective tax rate is calculated from your income statement, which is based on accounting rules and not based on tax rules. Unused tax losses, tax credits. So recognize unused tax losses and tax credits only when we expect future taxable income where unused tax losses and tax credits can be applied. So the key point here is These unused tax losses and tax credits, these are like assets, so this is something that will benefit us in the future. So IFRS only allows us to use these credits and show them as some sort of an asset when we expect future taxable income where this asset will actually be beneficial. So in a simple example, let's say you have some tax credits, but the company that you are evaluating has tax credits, but you are not expecting any taxable income in the future. So if there is no taxable income expected in the foreseeable future, then those tax credits are of no use, and hence IFRS does not allow the firm to recognize tax credits if those credits will be of no use, which is fairly logical. US GAAP, however, takes a slightly different view. Deferred tax asset is the deferred tax asset is created and recognized in full, but is then reduced by something called a valuation allowance, and I will talk about this on the next slide. The greater the history of tax losses, the greater is the concern regarding generation of future taxable income. So if the probability of tax losses is high and we have a deferred tax asset, then according to US GAAP you create a valuation allowance, and when you create this valuation allowance, that is a contra account which reduces the value of a deferred tax asset. And for deferred tax asset recognition, the following criteria are useful. So you need to look at the uncertainty of future taxable profits. If the uncertainty is high, then at least according to IFRS, as we just saw, we should be careful creating deferred tax assets. And similarly, if there are tax losses or credits which will expire soon before the company becomes profitable, then again it doesn't make sense to create deferred tax assets, and so on. So as I said, let's talk about valuation allowance in a little more detail. The DTA or deferred tax asset must be assessed at each balance sheet. So now this is according to US GAAP, where valuation allowance is used quite extensively. If the DTA will not be realized because of insufficient future taxable income to recover the tax asset, then the DTA must be reduced. Under US GAAP, DTA can be reduced by creating a valuation allowance. This reduces the DTA and net income. So my advice to you is, think of valuation allowance as a contra account, just like depreciation. So depreciation is a contra account which reduces the value of fixed assets. Similarly, valuation allowance is a contra account that reduces the value of deferred tax assets. So if your valuation allowance goes up, that means your deferred tax asset or your net deferred tax asset is coming down. And notice that when your valuation allowance goes up, think of it like depreciation going up. What happens when depreciation goes up? Net income comes down. So if you see a question that involves valuation allowance going up, that will have two impacts. The value of your assets go down, specifically deferred tax assets go down, and since valuation allowance is like an expense, it is in fact an expense, net income also comes down. DTA can be revalued upwards by decreasing the valuation allowance, which would increase earnings. Presentation and disclosures, this is an area which I think is probably low probability in terms of testability. So I would just encourage you to read this slide. Don't spend too much time on it, but in simple terms, presentation and disclosure rules are that deferred tax liabilities and deferred tax assets need to be disclosed separately. in the US GAAP world, the valuation allowance needs to be shown, and any net changes in valuation allowance over a period need to be shown, and so on. So I'd say just read this. If you feel extra diligent, go through the long example in the curriculum, but do not get too hung up on this. And similarly, comparison of IFRS and US GAAP. Here again, my view is that this is not a very high probability question. Just recognize a few larger points, and then if you feel super diligent, you can go through the long exhibit or the long list of differences between IFRS and US GAAP in the context of income taxes. But again, don't get too hung up on this. The core points are that accounting treatment of income taxes under US GAAP and IFRS are similar in most regards. Differences relate to the revaluation of fixed assets and intangible assets. Upward prohibition is upward revaluations prohibited under US GAAP, but generally permitted under IFRS. So again, as I said, if you feel super diligent, go through the whole list. But what is much more important is that you practice. And there are about 20 to 25 questions in the curriculum, and I believe that based on what you've heard here, you should be able to attempt those questions, spend a lot of time on them, and carefully read the solutions at the end after having attempted the questions. If you do so, I am quite confident that you will be well prepared for your exam. So good luck, and that is it for now.